out.
Yep.
I didn't notice, but there is a bunch of interest rate meeting this week.
Interest rate data, you said?
Meetings, yeah. So
yeah.
RBA, Bank
Yep.
of Canada, Swiss National Bank, and the European Central Bank.
Oh yeah, you've got a busy week here, and then of course the Fed goes December 18th. So it's a big monetary policy week. I didn't notice that either, but that's going to be really important to gold prices. It's going to be important to individual currencies, of course, for the respective central banks. So great to point that out, Ivan. And yes, central bank stories coming at you guys all week long. And of course, the big CPI event on Wednesday out of the US will probably be a headline event for the week. Ivan, before you go, before I kick you out, everybody make sure to go subscribe to Ivan on his own social media, his YouTube channel. You can find him on YouTube. You can find him on socials. And if you're in the Discord, you can also send him a direct message and ask him about one-on-one coaching. You can also do so by contacting him on his own socials as well. He does one-on-one coaching if that is something that you're interested in checking out, working with someone privately who can take it one step at a time with you. If that is something you're interested in, make sure to go subscribe to Ivan and send him a direct message for that information. Ivan, thank you very much for coming on, man.
Thank you very much for having me.
All right. Okay, guys, now we're going to transition here to Chris Pulver taking over the show here for about an hour. So make sure, don't go anywhere. Chris Pulver, of course, talks all sorts of different markets. He'll talk everything from currencies to commodities to stocks and options. And I'm also curious to hear his thoughts off of the big pop in China. Almost 7% up move on the Hang Seng Index. I mean, that's a big move for the day. So Chris Pulver taking over right after this. Check it out.
'Twas the night before Christmas, and all through the house not a creature was stirring. Except Chris Pulver, apparently, who just took a trade on gold. It's the middle of the night, I'm not really sure how he did that. Pulver alerts are now available at A1Trading.com. Get exclusive access to Chris Pulver's trades with A1 Trading's Pulver alerts. Watch as Chris Pulver, a seasoned trading pro, navigates the markets, manages risk, and applies a disciplined trading process. Join today to level up your skills and learn from Chris's wealth of experience. Get Pulver alerts now.
What's happening, everybody? Happy Monday. I'm about to put on some fresh trades this morning. And I did this last week on Friday for my final hour session from 3 p.m. to 4 p.m. I put on a hedge on the SPY. I'm going to go ahead and put in a small trade on the MES, which is the micro futures for the S&P. If I buy a 61.60 put, it's going to cost me about $290. It's a fraction of my account, like a 0.2% risk. I can risk the whole thing. Any downside move, any downside that we have, I would say if we come back and retest, any gaps or gap fills, I'm looking to do some quick hedging. I'm doing this because the IV rank is so low on the SPX and so low on the SPY. Any type of uptick we see in volatility would probably be a downturn in the market. We do have, like Elvin and Nick said, 6 rate decisions in 2 weeks. 4 of which are coming this week. We got the Fed and the BOJ back-to-back next week on Wednesday and Thursday. We also have U.S. inflation data this week on Wednesday and Thursday. So that being said, I'm going to go ahead and take a stab at this one, a 61.60 long put. See if I get filled here for about $57 to $58. Let me get $58 or less and take a look here. So let's go. Filled at $58. There it is. So there's my $58. Add this in. This is going across the board on everyone's account. So just give me a moment to place these trades. Okay, almost there. Oh my gosh. Dave, if you're watching, you're killing me, dude. I need you to get on that future stuff. All right, let's try this one. And this one. All right, so that is in. I'm going to update that in my tracker. I'll put that in Discord as well for my Pulver alerts. I'm going to go ahead and set a chart alarm. I'll move this one up to around 60, 61. This is the SPX feed. Actually, let me move this. I kind of like that area. That's bear call spread. I'm going to update this and say check on check MES long put. Okay, and on that, let me take a look at the MNQ as well. Actually, let me just check the Qs for a second, or NDX. What would this area be? If we came back to retest this level, 21.4, how many points away is that? 21.4 would be about 115 points lower. We'll see. I think I'll just stick with it. I already did the SPY. There's the S&P. Nasdaq might be a little bit more vulnerable. I just don't want to overpay for the option. Let me see what it would cost me if I did a MNQ. So if I went /MNQ for micro Nasdaq, went out to the end of the year, buying at the money put. I already have a 21,200. This would cost me about $600. Yeah, I'm not going to pay that. I'm gonna keep it at like $200 to $300 for the hedge, with no real cap or having like 300 to 400% upside on those if we have a downturn. So all right, let me post that in the A1 Trading Pulver alerts. So that's going to be under futures trades. This is a new trade /MES 12/31 expiration. And I bought the 6160 put, paid $58 debit, filled, and that is for max risk about $200, max risk per contract, and there's no profit limit. I'll be happy if profit shows, let's say, $500 to $1,000 in gains as a hedge. All right, so let's go MES here. There's my feed. Where am I looking to take this down towards? We're already turning red for the week. I suppose if we took out last week's low, so we've been inching up with these slightly higher highs. I thought it was interesting. Like, we've had 57 all-time highs in the S&P this year, but over the last, let's say, month, these all-time highs have been pretty lackluster. Like, literally, you're talking about a new high that's like 0.1% higher, and then the only one we had a decent stretch on last week was we gapped open from Tuesday to Wednesday. So Tuesday's close to Wednesday's open was a gap open, and then we melted up on Wednesday, and that ended up being a 0.5% move in the S&P. Everything else has been like these 0.03s, 0.05s, less than 0.1%. All I'm saying is, if we were to head back down and actually challenge a low, then I want to protect some profit. So I'll put a 60-40. This would be taking out previous week's low. Check for hedge profits. So just before we get to those lows, that's enough for me to say, yeah, it's a good little chunk to the downside. Point wise, if I turn that into like a $50 move or a 0.8% move, depending on what happens with, IV rank or implied volatility, we might see those option prices increase pretty dramatically, especially if this happens, let's say this week. I bought the timeout to the end of the month. If it happens this week, I'm going to get that extra, the acceleration move, which is kind of my delta will increase, my gamma increases the delta, and that could end up, that $290 risk could certainly pay, maybe 50%, 100% gain, which I don't mind. I'm just doing it as a hedge. Okay. All right, so that's what I'm going to look for on at least MES for right now. I'm not going to pay for the MNQ unless something happens, but I already have positions out there a little bit longer. Now let's go back to what Nick had said earlier, China, big deal overnight. I saw this headline last night. They injected like 474 billion won into the market. We have a 2.7% jump on HSI. We've got Alibaba ripping to the upside as well. JD, I've got an income trade on JD. That's a nice move back into the 40s. Let me take a quick peek at my JD positions. And I mean, really, my China positions overall are doing a lot better. Part of my P&L today is all because of China. $22,000 to the upside. I've hit a fresh high in my portfolio for the year, and a lot of that is, look, it's not done. I'm just trying to figure out, like, what do I need to do to preserve some of these gains, and roll down some I could roll down some calls, or I could roll out some calls. I could roll up some puts. I could do all sorts of stuff to try to generate additional credits on some of these positions. So if I take a look at Baidu, for example, okay, I have 111 shares. Currently, they are covered at 95. Now, that is a way to just get out of the stock for a couple of bucks. My break even is in the low 90s. So let me double check something here. Because now that we're up, I mean, I might benefit from like maybe 1 week out and get a roll out of that. Let me see what that's doing. So it is showing, let me get this over here. There we go. So right now I've got some profit on that call, but there's a lot of price jumping on these option chains with that big push to the upside. So let me see if I can roll this out, and let me see what my net break even is on my tracker here. So I'm going to go BIDU and go to my break even. So right now I'm showing a break even around $88 and a break even of around $87.50. So if I have a break even, let's say $88, and I get it called away at 95, I'm still going to keep 11 shares. And I don't know if that was from like a dividend play or something. I don't know how I get. Oh, actually, never mind. I bought 11 shares because it was a $1,000 allocation. That was around $100, and then I kept on a credit spread. I kept another 100 shares. So anyway, if I turn this into, let's say, break even at 88.18, get it called away at 95, and make 682 on 100 shares. It's an income trade of $682, and I've got that on 1, 2, 3, 4, 5, 6, 7, 8, 9, 11 accounts. So it's a decent chunk of profit just on Baidu. Could I roll this right now? The rest you can see here, an 85 by 80 bull put spread, 80 by 50 bull put spread. Those are fine. Those are looking fine for profit. I'm really looking to, keep the income, and let me see if I can do a quick roll on this. So if I roll this out by a week and I keep the strike the same, I get 55 extra cents for that, which is not a big deal to me, to be honest. It's, especially just one contract that, make an extra 50 cents is not a bad deal, but more than anything, it just lowers my cost basis in case it doesn't get called away. If I wanted to increase this is where it gets a little dicey. I can increase my strike by $1 and I can still receive a net credit for that. So if we are going to see more upside, if I just go to the price on Baidu right now, let's go BIDU. I mean, if we get back to anywhere close to these September highs, Baidu is trading up at $115, $116. So for me, it's like I'm kind of stuck right now to say, like, there's not really a lot I can do with a 95 unless I'm going to go out even further. So to that point, I could go out further in time, and I could give, typical seasonality would be, okay, if we have a Santa rally where nothing really disrupts the market, China continues to announce additional stimulus and kind of lift the animal spirits, and we get a nice little rally into the end of the year. I just don't want to go out too far. I mean, I said if we have China stocks revisiting the previous highs from September by the end of this year or into I really January, it's like I don't even want to say Q1, then I'm going to look to take some profit. So if I go out a little bit further, let me take this down to 95, keep the strike the same. If I roll this out in time, I mean, so I go out 2 more weeks, I can get an extra $1. Now that's not bad. I turn my income trade from, almost $700 into $800 of profit. That's okay for a couple extra weeks. If I go out a little bit further, could I roll this out to the January 29th or January 10th and also increase this by $1? Now I can increase it by $1 and get 70 cents for that. So going out 2 weeks, I can get an extra 70 cents and also increase my strike by $1. So that gives me another $170 over the same period. That's not bad. Could I increase this one more dollar? Now I could get $2.38 of profit, right? So, I mean, I can, this is interesting. How much further do I have to go? So that's a big jump in the strike price. Notice how the strike prices go from 95, 96, 97, then they skip up to $100. I have to pay for that one because that's $5 higher, but I'm only paying 50 cents. You know, I'm paying 50 cents to get another $4.50 of profit. But the problem with that one is it's a debit. So that would increase my cost basis. So if I went to 97, if I can get 40 cents and increase by $2, like that's a pretty good chunk for $2 of holding. I might do that actually. Let me see if I go out another week. Okay. So, all right, I can't, if I go to the monthly expiration on January 17th, the strike prices suck. They go from 95 to 100 to 105. They don't give me the flexibility to trade within that kind of dollar strikes. So I'm going to take this down to the January 10th expiration. I'm going to roll this out to the 10th and roll this up to 97 and see if I can get like 45 cents on this roll. So I'm going to roll this out 2 weeks and up $2, try to get 45 cents. 68.30. Not filling at 45 cents. Let me try to work this down to, let's see if I can get 40 cents out of this. You turd. 40 cents not filling. 35 cents final offer. Not filling. Son of a gun. All right, I'm going to cancel that. All right, let me not bore you with those details. Let's go through the. I'm gonna work on this, you know, offline here. But I've got BIDU. I've got Alibaba. I do have some shares. We're up to 92. Alibaba overall is looking really good. I've got credit spreads, ratio spreads, all sorts of stuff on Alibaba. This one for my overall account should be a decent profit. Alibaba is up around $7,800. Baidu right now is still, because I have the ownership, this is where I'm down the most. But if I turn, you know, 11 accounts at $700 each, that's, you know, $7 grand, $8 grand in profit, and I'm showing upside down 38.50. So that's a pretty big swing. That's like a 10K swing in profit for me, which I'm happy to have, obviously. And then some of the other ones, I have the FXI exposure. I'm up $8,100 in FXI. I do have some shares of that one, and they are currently covered at 29 out to December. This is one that I probably should consider rolling if I can get it rolled out another week. This is probably a good one to roll. So let me take a look at this one. So JD is another one. I have 500 shares. They're covered at 38.50. So I'm going to look for some rolls on this one here. FXI 33.25. I have the shares. They're covered at 29. My break even on FXI. Let me check. Break even on FXI. Break even on FXI. Still looking. Okay, that diagonal spread was rolled. There we go. 24.26 is my break even. 24.26 is my break even. So right now, if I did nothing, okay, 24.26, get it called away at 29. So I make $474 per contract. Okay. Now what I'm going to look to do here is, since we're trading at 33.26, I'm not looking to get super greedy here, but if I can generate just an extra credit and maybe another week, get this out by the end of the year, let me look at a quick roll. So right now, if I roll it out by, you got to be kidding me, man. If I roll this out by a week, they're going to tell me to pay for that. Well, that doesn't make any sense. If I roll it up, let me try another expiration here. So the 27th of December doesn't look good. That doesn't make any sense. $29 call. Quick roll. I'm surprised it's not showing a debit. Or I'm sorry, I'm just surprised it's not showing a credit. That is weird. Let me go out another week. I don't think I can get anything for this. All right, the bid ask on FXI is super wide, so that may be something I just have to let it get called away. You know, and it's fine. I mean, I have credit spreads here, the 30, 50 by 30, the 31 by 30. Those are actually looking pretty decent. Let me see if those are in profit. FXI here. So FXI, where are you? There it is. So my 31 by 30 is trading for just under a 50% profit, 50% profit. And then my 30.5 by 30, this one, probably not a bad spot. Let me check those prices. These both have some decent profits. So my 31 by 30, I got into that one for just shy of 50 cents. So that's 214 minus $1.57. I collected 57 cents on that. Okay, and this is out to the 20th, which should be next Friday. So can we stay above $31 by next Friday for full credit, or do I want to just take the profit and run? Right now, it's up about $210. My max profit on this one, I'm trying to think what my max profit is. I've got 57 times 500. Nope. 57 times 500. My max profit is 285, and I'm up 210. So 210 out of 285. I've got 74% of the profit today if I want to take it, and I have no risk on the trade if I just take the profit and run. Same thing here. I collected about 27 cents on this one, and it's trading down to 8 cents. So I could take the, it's roughly $200 of profit. My max profit on this one would be 270. So what's 200 divided by 270? So each one is sitting around 73 to 74% of my max profit. Probably not a bad thing just to protect, just in case. I mean, I don't know. I mean, if there's any disappointment where it's like the market's caught off guard and all of a sudden it's like, oh, this stimulus doesn't mean that, doesn't mean what China's saying it means, and the market fades it. I don't know. So if I've got the money in front of me, I'm probably going to take it, protect it, also minimize some of this exposure. I'll keep some of the ownership on Alibaba and Baidu. I don't mind having those. I'll keep the JD position as well. So I'm going to try to roll those and mess around with it. But it looks like FXI, it doesn't look like I can roll it for any credit that would be worthwhile. So I'll probably just take the profit on that one. JD, Alibaba, Baidu, I'll kind of work the shares that I have. KWeb should be fine. I've got some long calls on that one. So anyway, everything in China is taken off, which is a good thing. Okay. Yeah, good question. Blaze says, do you even understand what you're trying to explain? Nope. I have no idea what I'm doing. None whatsoever. I just come into these sessions and just randomly talk about stuff that makes no sense to me whatsoever. Okay. So anyway, no, I'm just walking through everything that I'm just thinking out loud. That's the nice thing about, look, here's my live account. Here's my portfolio. This is stuff I've got to do every day from opening bell to closing bell. And so you're just getting a snippet of like, this is what my brain does for the hour. That's from 10:15 to 11:15 or whatever I'm live. I'm just talking through my trades. Okay. So anyway, offline, I'll work on the rolls and figure out what I'm gonna do with that. But a lot of my P&L today is because of that big jump in China, which is totally great. Amazon's hit some all-time highs. Let's do some top down. So we're sitting here kind of red for the day. S&P down about 0.3%. Q's down about 0.6%. The Dow's flat on the day. The Russell is down. Actually, this is interesting. The IWM is up 0.3%. But the IWY, which is the top 200 growth, is down about 0.5%. IWX is the top 200 value, which is flat on the day. I'm going to watch and see. I think that these small cap. So the IWM is your traditional Russell 2000. Your IWY is your top 200 growth. I like the idea of kind of playing the top 10% of the small caps. Growth is going to be probably more of like any small company that's getting into the AI space could be showing some benefits through this IWY ETF. And then the value side, I'm still not convinced that we go into like full on value trades. I think moving forward, you're just going to have good companies that have limited debt, that have high margins, have good cash, have just good fundamentals. And I'm just tempering expectations to think like, I mean, if you think about this, from the bottom in 2022, if I go to the SPY for a second, okay, from the bottom of 2022, which would have been that October low, this market, and I know that this is like calling the bottom here, but just the pace that this market has created in 2 years, the SPY is up from actually that's 2023, my bad. Let me go even back further. So for the last couple of years, I meant to go the 2022 low. So this is in October 2022. Okay, this market is up 74% in just over 2 years of trading. Okay, so that's 37% per year since the October 2022 low. Now, I know that that's picking a bottom, but from that low to now, we've had an incredible run on the S&P and an incredible run on the Nasdaq. Now, typically the S&P is on pace to do about 8 to 10% a year. We know for the last decade plus, this has been like a 15 to 16% annualized gain. We are like nearly doubling the performance of the average S&P, right? All I'm saying is I don't know if the S&P can produce another 20 to 25% year. I don't know if we can produce another 20, 25, 30% year. I think that when our S&P, price to earnings valuations are in the 25, 26s, I showed this screenshot last week, and I'll just revisit it. Okay, right here. The last time we had this big price to earnings valuation was during COVID, and it's this number. Let me box it in. The numbers might be small to see it, but 2020 price to earnings was 30.7. Okay. What happened and again, it was a nasty month, right? But I think that we kind of bought our way through and stimulated our way through what should have been a reversion. That COVID crash was this little excuse that the market moved to offer up like 8 to 10-year discounts. And it did, and everyone bought it. Okay. And then 2020 through the rest of the year and 2021 through all the momentum until we topped out in November 2021 and January 2022, those valuations were bananas. And now that we're sitting here at 26, just saying we're a little frothy. Okay. Valuations matter. Reality matters. At some point it matters. And so if the Mag 7 starts to stall, that will weigh on the S&P. If the broader market starts to crack, it'll weigh on the S&P. If inflation, and we've had this conversation, we have inflation data Wednesday, Thursday. We're expecting to see a 2.7 print, which is 0.3 higher than our low. You look at your edge finder, we're starting to trend the wrong direction. I said, 1 month doesn't make a trend, but this would be 3 data points. 2.4, 2.6, and this is a forecast at 2.7. That trend, if you connect those dots, that's showing that our inflation readings are going the wrong way, right? And the Fed next week is still looking to cut by 25 basis points with about an 85% probability. So I'm not saying that this has to be the reason the market just, fails and all of a sudden the market is just flipping to a bear market. I'm just saying that we keep going higher. We keep melting up higher at these 0.1% higher highs, 0.03% higher highs. Like this orbit, okay, this orbit to the upside is starting to sputter, right? So if it's just now we got a little bit of liftoff still going, a little bit of drift still going, I get it. But a reality check can rock this market a little bit with some volatility. And I just want us to be prepared for a little bit of shakeup. Doesn't mean the market has to crash, doesn't mean the market has to rip, but just a little bit of disruption. It's been weird to see that we're back down to those really complacent, super low IV levels that we saw in the summer before we topped out in July. When you look at the SPY, okay, with an IV of 7.1, that was right before we started to see the market top out in July. And this went from 7 IV rank to like 75. Now, yes, that was because the Japanese yen was deleveraging and we saw a lot more risk coming in mid-July into early August. Could that happen again? Maybe. Okay. How many of you are prepared? And I'm just saying, if this happens, how many of you would be prepared? And hopefully, I'm not going to say excited, but would you be prepared for dry powder to be deployed if the market dipped? And I think this is the concern is a lot of traders, when they're sitting here at these all-time highs, they're fully invested. Okay. I am not. I have about 45% of my portfolio sitting in cash. Okay. Is that by design? Yeah. I like to have, somewhere between like 25% available Sometimes when we're stretching these higher levels, I mean, yeah, 50%, I've got plenty of cash at the ready, which is good. But what happens is when we're sitting here at these highs and the market doesn't just keep going higher and everyone's fully invested, if we get a little bit of a shakeout, okay, most investors will panic, right? And if they start dumping positions or taking profit and just look, a discount is good. I'm still going to buy some discounts. I'm still going to stay the course. And I don't know if we're going to be full on crash, but I'm just saying from this point all the way down to this 200 moving average, we have about a 10% window to correct. Okay. If we come down to the 200 moving average, that is a 9.7% move to the downside. Now, I've mentioned this for months now, but if I'm watching the 200 moving average, we have a 278 bar count, which on the daily time frame is notable. It's not too extreme, but it's notable. Okay. And on top of that, we've stretched out where we're about 11%, 10% higher than the 200 moving average. Okay. From the recent all-time highs. So that would have been from last week. Okay. All I'm saying is from this recent all-time high to that level, it's 10%. You can look at this chart and you can see how many times this market has pulled back. Even this stretch away move here. Okay. We have a pullback. We have a pullback. We have a pullback, 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 we have a pullback. This is what the market does. Even in a healthy bull market, we have pullbacks. Then we had a correction. Okay, it pulls back here, pulls back here, pulls back here. That's all I'm saying. So I have cash at the ready for deployments if we have a better price. Okay, now, yes, it could go to the upside and people can sit there and say, like, well, Chris, you're missing out because we're going to go higher. Yeah, maybe we do. And maybe I do miss out as far as my capital that's not deployed, I miss out. But where I make up for it is if this market does in fact show a dip, and I'm not saying it has to be now or by the end of the year, it could be, Q2 of next year, could be the second half of next year. I have no idea. But I will be waiting for an opportunity to buy at better prices. Because look, historically, things are a little bit high. Valuations are high, price to earnings are high, price to sales are high, price to peak earnings are high. If earnings season is not going to crush it again in Q1, we could have an easy reason to fall a little bit or go sideways. Okay, so I want to keep the cash at the ready. I'll keep taping my stabs with these little tiny hedges. If it goes up, that's easy. If it goes up, everything else up. Right now, the good thing is the U.S. markets have still done really, really well the last couple of years, like extremely well the last couple of years. The total market cap in the U.S. is killing it. It's like 63% of the global market cap is U.S. That's how strong the U.S. economy is. That's how strong the U.S. stock market is. But then you look at world power number 2, adding stimulus, continuing to be vocal about stimulus, supporting the property market, supporting the capital markets. And every couple of weeks, they're pretty consistent right now. They're trying to put in a floor. They're trying to get some animal spirits lifted. And when you've got, U.S. resiliency plus, the Fed is cutting rates, that's fine to a point. When then they start to pause, they'll probably pause through most of 2025. But with U.S. and China both, supporting their markets, both wanting to see higher highs, it's not something I want to fight. So I'm not calling tops here. I'm just going to be prepared for, look, if we have a 3 to 5% correction, just be ready. If we have an 8 to 10% correction, just be ready, because what we don't know is why it's going to happen. That's what's so tricky. It's like, should it happen? Yeah, probably some type of pullback should happen, but I don't know what it's going to be, and nobody knows. It's like, it's the thing that nobody's talking about right now. There's no headlines about how the next 10% correction is going to take place. Nobody knows. Okay. I'm just saying that whatever lines up and the market uses this like bundle of things to say, this is why the market's going to correct. It does it, and it does it really, really quickly. But I think having cash at the ready, we've gone up, pretty much nonstop since late 2022. If all we had was a correction and then the market kind of picks itself up, a range is very tradable. Okay. What I don't think anybody's prepared for is a correction and a dead cat bounce and then a lower high, lower low. I think that move right there would be where everyone would start to be really fearful, because that would make some major structural damage. That would make for some major structural damage in the market, right? If we actually took out for the first time, like a high to low, right? And all of a sudden we're back up here to higher highs. But if we have a high, low, lower high to lower low, that's where a lot of traders, I think, would be, freaking out, dumping positions, because that could be somewhere between like 15 to 20%. And that's not going to be fun, right? And then you wonder, well, is there another one? Is it another lower high to lower low? And then it looks a lot like 2022. We'll find out. So just saying, be ready. I think the hardest position for investors to be in is to be fully invested and know that if it goes higher, it's easy. Okay. If it goes lower, it sucks. And I'm not, it's not me. I'm just saying, but a lot of investors that are just fully invested in these, leverage ETFs and in these leverage stocks, and be careful, because any type of downturn, leverage is a double-edged sword, as you should know. Okay. All right. So some other top downs, we are kind of red on the day. A pullback hasn't happened in a while. So here is your S&P. Actually, directionally, we actually saw a decent direction today on the SPX. So I am glad that I, snagged my few profits this morning. So we're starting out, in red for the week. Let's just note a couple levels here on the SPX. There's the high, there's the low. Is this week's trading going to do any type of damage to take out last week's high or low? Well, there's enough news out there with US CPI data, PPI data, also 4 rate decisions this week. By the way, everyone knows, or should know, who can throw in the chat here, what are the rate decisions that we have? I believe in this order, we have RBA, BOC, Swiss National Bank, and ECB all this week. This is supposed to be a pause, keeping rates at 4.35. Okay, the BOC is expected to be a cut by 50 basis points. Okay, the S&B is a Swiss National Bank. That's expected to be a cut by 25 basis points, with potentially more coming by the end of the year or into 2025. And the ECB is looking to cut by another 25 basis points. We also have US CPI, which is showing a 2.7% forecast, which is going to be 0.1% higher than previous. And that's going to be 0.3% higher than the previous low that we saw with that bottom in inflation at 2.4 before China started to get really aggressive on stimulus. PMI numbers going higher, inflation across the board looking like starting to go higher. Food prices going up. The only thing that keeps keeping, I think, taming inflation right now is oil prices. Oil prices at lows, oil prices not getting above $70. That keeps energy prices pretty low for now. If oil prices start to creep up into the mid 70s, that's not a good thing. I think that's when inflation really starts to make headlines again of like, oh my gosh, here we go again, second wave of inflation. But anyway, that's what's going on this week. Okay, and then we have US PPI. I just think more people pay attention to headline CPI. Okay, next week, we have the Fed. Okay, what are they expected to do? Cut by 25 basis points. And then we have the BOJ. Pause. I'll put that with that inflection of my voice is exactly how I'm asking this. Like, I don't know what they're going to do, but I think the timing of that is really interesting. We've seen some highs, some high volatility out of the Japanese yen pairs the last couple of weeks. We obviously saw the big deleveraging happening this summer. I don't think the Bank of Japan is going to do anything radical, but I wouldn't put it past them. So this is a lot of news for the markets to digest for end of year positioning. Whether it's like, yeah, it doesn't really matter. The market will react to it later. We're crossing, wow, is that a gap fill already? That was quick. Okay, so that's, let me just check the MES position that I put on this morning. So MES right now, December 13th, that's a small loss on that hedge for right now. There's my 61.60. So I'm up about $41 in profit. I'm going to see if this gets a little nasty to the downside. I also put in that debit spread last week on Friday. Let me check this SPY position here. So my 608 by 590 right now, this is up around $100. So yeah, I mean, the hedges are there for a reason. I'm going to see if something gets really nasty to the downside, then we will watch. Okay, BOJ monetary policy next week. Yeah, so that's why I said, like, the Fed and the BOJ back to back could make for an interesting, kind of finale to the end of the year. I mean, that to me is like one of the major data points that will have the market, it's got to wrap its head around all this stuff. But the next 2 weeks are big, and it either is a, price either is supported by the news, interrupted by the news, or disrupted by the news. Okay, so what I mean by that is price is supported by the news, meaning that the news just makes the markets go higher, and the path of least resistance continues to be the same thing. Okay, interrupted by the news means, oh, hang on a second, things are a little messy, things are a little sloppy, but it just pauses and gets a little shaky for a moment, and then the initial trend or the already established trend is still in motion and can't be stopped. It just was a little bit of a head fake. Okay, disruptive is why I'm hedging. If we have something disruptive where all of a sudden we take out a previous low, we pull back and we fill some major gaps, and all of a sudden the trajectory we've been on just completely changes, that's disruptive. The news can do all of that, right? Supportive, interruptive, disruptive. I don't know what it's going to be, but it's enough for me to pay attention. Okay? All right. So just take a look at the simple indexes again. This is a 21 period moving average and a 50 period moving average. There's no major structural or technical damage done unless we were to take out this low right here. Okay. If we took out that low, then I'd say, okay, that's a pretty decent correction. That would be coming back towards the 100 moving average. And to me, between this 100 moving average and the 200 moving average, I would look to add more positions, and deploy some of that cash. Right? Until then, I'm going to be hedged to try to find the 21 and find the 50. I'm going to be hedged until we find those levels. If I lose on the hedges, so be it. Because for me to sacrifice, let's say 0.2% of my account on a hedge, but the market goes higher, look, I can get an extra 1% there. I can get extra 2-3% there. I mean, today, my whole portfolio is up, I don't know, over 1%, 1.5%, just on a lift in China. So anyway, we'll see. I just want to be mindful that these moving averages could be retested. And if they are, I'll take off some hedges for some small gains. I'll look to deploy some capital if I like the levels I'm at. And I'm watching this in all the U.S. markets right now. Okay, volatility-wise, let's see where we're at. VIX is up about 8.6% on the day. We're going to see if these numbers change at all. Here's my SPY at 7.9 IV rank. Just make a mental note of that. Single digits IV rank. Does this jump up to 14 or 15? Does it jump up into the 20s? If so, we're probably going to have a bit of a move to the downside. Okay. All right. Dollar index. This is the one spot that I'm watching. I talked about this last week on the 4-hour time frame. Just don't take a head fake on the dollar. Okay. If the dollar is going to close below this 200 moving average, this is a 4-hour time frame. If the dollar index, this is DXY, closing below this 4-hour 200 EMA, if it closes below there, I'm looking to see, do we have a pullback and then a fresh low? I would look for a trend opportunity to see if the dollar is going to be fading some of this. Doesn't mean I'm short right now, because I said this market might still be bouncing off that area. Okay, still be a range trade on the dollar where it's supported in here, catching bid right around that 200 EMA. So I don't know, but this is the level that I'm watching. It's right around 105.50. So for right now, if we stay above 105.50, for some Forex scalping out there, I would look for the dollar to gain some strength. If we're less than 105.50, we want to see if there's some more downside to come in and find some, inefficiencies, or, okay, nice run on the dollar, come back and find some equilibrium, maybe be a big range trade. Okay. So it's just a couple levels that I'm watching. Really, it's that 105.50 is a really kind of critical spot for the DXY this week. Okay, we'll keep a close eye on that one. Oil prices, like you keep saying, this actually is a pretty shifty move to the upside. Oil prices on the day, up 2%. It's still making lower highs. It's still making equal lows. If we break the floor, it's probably good for inflation. If we break this structure and we get greater than, I'd say 71, if we get greater than 71, that's going to take out some previous highs. If we take out this high, take out this high, take out this high, that's probably showing that oil prices are looking to squeeze, right? And so do we get into the mid 70s? If so, that is probably not a good look for inflation. It's not that far away from either being like this market has to, break or fake out. I don't think a lot of traders, I wouldn't be surprised if oil prices go higher. I think that we are trying to force oil prices and try to bend it to our will of just go lower. Like oil price, I mean, I don't know. There's so many geopolitical things happening with oil that even a straight up Middle East conflict hasn't brought oil prices up. And now if we have domestic drilling in the US and deregulation from the US and maybe it stretches globally, I don't know. I don't see how oil prices are going to be, quick to gain, but the inflation shock, the quick like sticker shock would be like 75 to 76 would definitely be a bit of a squeeze. So the floor still sits around 67. Anything greater than 71, I think that makes inflation look a little bit stickier. Okay, natural gas, I'm going to wait on that one as well. Gold's got a pretty decent run finally after 8 days of indecision. I'd said this, I'm not really doing much on gold other than waiting, right? Yeah. Eunice, would you like to see gold? Type it in the chat a couple more times for me. Okay, we had 8 days of indecision. We're finally starting to get a bit of a break. Now, does that mean I'm going to do anything with it? No, because I'm already long. I'm still going to wait and see, do we have a correction? Do we have some? One thing that was nice, I saw gold ticking higher and I saw silver outperforming. So that's probably another reason that my portfolio is up today, because I do have some SLV, I do have some GLD, I have some SI futures and GC futures. That's good. Okay. But right now, with this larger candle, all this to me is inside candle, right? There's no real confirmation that gold is going higher or lower until we break away from this big red candle right here. That nothing matters. Like this doesn't matter. This price action doesn't do anything for me. Okay? So I'm still prepared for a high, low, lower high, lower low. This is still where I'd like to add more to my gold exposure. If you want to draw a trend line and wait for more confirmation, then let it get on the right-hand side of that trend line. Otherwise, this is inside this bar. It doesn't really matter. It's a little bit exciting that gold's up 1.3%, silver's up 3.7%. That's great. Okay, we can compare that with a XAU and XAG chart. And we've also gone back on this one for the last, 6 to 12 months, and we've seen that since 2022, there's kind of a range performance on gold and silver. Now, the nice thing is both of them individually have been in a bull trend, okay? But when we see that this is heading lower, that means that silver's getting the upper hand right now. And I would love, personally, I'd love to see silver do this. I'd love to see silver outperform and come back into these range lows, and I'm curious where that actually takes the spot price of XAG. I have a measured move around $38.80, and then my other one's around $44. So if I could hit target one on silver, whatever, this year, Q1, Q2, in the next 12 months, I don't really care. I'm just targeting that move. So if silver can outperform gold, that'd be a good thing. Okay. All right. So here's silver. I mean, that's a pretty nice bump right off the backside of this trend line, still well supported with all these moving averages. I said watch this like 29 to 29.50 zone for support, and also this really key level at 26. So far, technically this is behaving pretty well. If this is, a pullback into fine support, and then we're coming back up to hit this measure move, there's my 35. Actually, I think I said 38.80. I'm at 35.80. Sorry, 35.88 is my target one. So am I going to take profit there? I don't know. It depends, but I'm still going higher. I think we can get into the 40s. I'm looking for the 40s plus on silver. Okay, Bitcoin, a little bit of a retreat off that poke at 103. 103.7. I'm sure there's still plenty of bids out there. Just take, if we have a low and we have a high, I mean, it looks like with that 103 level, I'm going to go ahead and put that in as a fib. Okay, spike off to 605. Nice. That's fine. Yep. So we're getting deeper into the red today, which I'm totally okay with. This is why I hedged on MES, and this is why I have the SPY. I mean, being up $3 isn't a big deal, but being up hopefully maybe $10 is better to at least make some money if we have a downturn. By the way, am I good for the next like 6 minutes or so? 6 to 10 minutes? You haven't pulled me off yet. You haven't Sandman me yet. So I'll keep going. So Bitcoin, I'm just going to drag low to high. And where do we look? So if I saw Bitcoin pulling back into the 382 zone or even the 70% zone, I'd be looking for a bull pattern in here or some type of, if it dips hard, like draw an aggressive trend line and then wait for the right-hand side of the trend line to be adding to it. So, I'll wait. I think Bitcoin getting some dips and pullbacks, post-election, we hit 100K. That was a big milestone. It's fine, Um, but I do wonder, just the way that things are shaping up right now, all this news is coming out this week. Are we going to have like an aggressive pullback on Monday? One thing that the market might spend all week doing, by the way, is this. Let's say we pull back on Monday and we stabilize here, and then the rest of the week we finish right back where we started. So I might look at some opportunities in the near term to find, something. I don't know. I might look for some opportunities if I spot them. So just seeing. We have three bullish weeks in a row. If we take out last week's low, that's fine. Does it do any major damage? It just. This is previous highs. So does it come back down there and test it? Sure. Then look for a bounce. But we'll see. I'm just curious what the week gives us. Last week's high, last week's low wasn't a big week as far as price. It only moved about 66, 67 points. It's like $6 or $7 on the SPY with an average of like 13. So the volatility again got really, really low. Okay. All right. Anyway, I left off on gold and silver, then Bitcoin. Let me go back to this chart here. SPX. There we go. That's a pretty big directional day on SPX. Here's Bitcoin. I'm going to wait and see if we get some pullbacks into this, like I said, 38% to 70% zone. That'd be a sub 90. Okay. We come in less than 90K. That looks like a bit of a bargain. If we come into around 80K, then I'm probably going to add more to my Bitcoin. I might buy another tranche of IBIT, FBTC. I might put in some options there. I might dollar cost average into just straight up Bitcoin right around 80K. Okay, and I might not get it. I might not get that pullback, but 90K and 80K, that we know there's enough volatility. I just see that we have some post-election inefficiency. So for a healthier bull market, I'd almost like to see the pullback get tested and then resumption. But if we just keep going higher and higher and higher, eventually that runs its course and we still end up coming back to that level anyway. So if we pull back to it now, that looks like a much healthier bull market environment to then, build and base, come back to previous highs over here, and then justify another support level, right? So 90K, 80K, watching those levels closely on Bitcoin. Ethereum probably also pulling back a little bit. Yep. So from recent highs at 4,100 back down to 3,820. My exposure is I need everything to stay above $60, which I think it will. ETHA, same thing. Copper. I keep saying this on copper. If China is going bullish, copper probably looks good. Japanese yen. I'm going to wait and I'm going to hope that the Japanese yen gives me something good to trade. If we come back down to these levels on Japanese yen futures, I will be long Japanese yen futures. Probably through credit spreads, but there's a QQQ move to the downside. Okay. Nikkei still choppy. I still have some shares with EWJ. DAX from fresh all-time highs. We could also be looking at some pullbacks. FTSE still chop. Oops. Oh, no, don't do that. There we go. HSI still up. Wow. That's crazy. That's a big, big, big move for the day. So from is that right? I feel like that. What is this? Yeah, Hang Seng futures. Wow, that's a huge move, man. The HSI itself. Wow, HSI futures. That's a crazy difference. Look at that. This is some serious movement in China. Okay, well, we had that rip in September. Technically, this actually looks really good. To have this big move to the upside, we fall. We're forming what looks to be a bullish pattern here. I see this playing out one of two ways. Either this rips up here, bull flag, and keeps going, okay, which would be like this kind of the same type of pace that we had in September, which is like China could do no wrong. This thing rips. Could we rip this to symmetry? That's possible, right? We go from low to high, higher low to higher high. That'd be an incredible run to have this type of impulsive move be matched by this next kind of wave of stimulus that's happening right in front of our very eyes. The flip side of that would be a price pattern. We come in here, we have a pullback, and then we break this as a neckline, and we have another measured move to the same highs or slightly higher. But there's not a lot that I see price action wise on HSI or even China stocks right now that don't lead to higher prices than currently. So I mean, right now, I mean, speculation wise, it might not be a bad spot to be looking to get long China. You've obviously had some discounts from that September move. If you're looking at something fairly attractive, I would say Baidu. It was really attractive. I should have just bought some freaking shares. I just put in that credit spread. This is a Pulver alert. I mean, I put the 85 by 80 out there. I should have just bought some damn shares. I should have bought maybe $1,000 to $2,000 of fractional shares because that would have been a great trade. I mean, right now it's up 17, almost 18%. I think there's room to get back to the September swing at 116. But I say that I already had exposure on China. I had $40,000-$50,000 of profits in September. That was pretty much cut in half, or maybe even cut by 2/3 or almost 3/4 with some of these pullbacks that we've seen. So I got a little hesitant to get super aggressive on China because the market just seemed to almost call the bluff for a second. So anyway, something to watch. All right. That being said, let's take a look at Mag 7s for a moment. We did gold, we did silver, we did Bitcoin. Dollar index wise, watch that 105.50 zone. Apple, fresh highs on Apple today. Amazon all the way up towards 230. Wow. All the way up towards 230. We'll see if Amazon can sustain these runs. It's still one of my favorite stocks out there. Google looks pretty darn good. I'm going to add some more positions on Google. Let me see if I can get I might do a ratio spread on Google. I'm willing to kind of own some shares here in like the 140s and 150s. I think I already have that trade running. Let me double check. Google. I have a 155 by 150 ratio spread. So I do have that one running just like I said. The 165 by 160 is a credit spread, and the 130 is a cash secured put. So, right now, I'm probably up like $7,000 or $8,000 on all my accounts with Google. I don't own a single share. Could I do another ratio spread? Maybe. I already have one. We're up a little bit. I think what I can do is I'm just going to look out probably the next 12 months and just stack time-wise. I'm just going to stack some credit spreads and say I think Google can go higher. I think that's a pretty safe play. If I said from 175 today and I go out 12 months, is Google going to be higher or lower? I would like to think that if we go lower, I can also take some shares in ownership. If we go higher, that's just income. So that's probably what I'll end up doing on Google. Is I like the price. I think we get up to these recent all-time highs back in July. If we break those all-time highs, and also too, I mean, energy, AI infrastructure, CapEx spending, future outlooks, consistency, makes money, limited debt, controls. I mean, Google is a monster player in large cap tech, right? Doesn't mean that large cap tech is the end all be all, but it's going to be hard to dethrone a Google or Apple or Meta or Microsoft or Amazon for that matter. I don't think Amazon necessarily is in the same space as the others, but AWS is a big deal. That's a huge part of the revenue, but it's hard to dethrone Google. There's going to be some small cap private equity competitors, right? But it's going to be hard as a whole to be, does Google ever get replaced as a top 10, top 20 stock? I don't know. Probably not. It's going to be an interesting world in the next 5 or 10 years. The adoption of AI and how fast paced that can be, we might just see a lot of private equity plays. And on that note, I think I added, hang on a second. Yep. So I added PSP. I shared this in my Pulver alerts. PSP it's an ETF that allows me to have some, and it's actively managed, but it's an ETF that allows me to basically trade private equity. I had a lot of this in the hedge fund world. Private equity, it comes in all sorts of shapes and sizes. There's obviously companies that fail. There's companies that do extremely well. I've argued for the last couple of years that private equity might just be some giant bubble, but it's essentially, if you believe that this company is worth something, you put it out there in the market privately and see who's willing to pay for it. And so if valuations keep going higher and higher and higher, private equity shows gains. You know, and then if you end up selling something to private equity, or you end up you know, arbitraging and getting rid of things of private equity, you know, those that had it make money. Those that have it now just end up paying more money for it. But it's a weird market, because if it's worth something that somebody else wants, it shows positive gains. But private companies don't have to go public, and if they don't ever have to raise capital, if they don't ever have to go and say we need shareholder money, we're going to go public. I think that's what's interesting about the next maybe 5 or 10 years is we might have less IPOs, less publicly traded companies, as far as like new ones, right? And those that are just going to be like, they're small, they've got plenty of raise, they got plenty of capital, and they, you know, run like a very aggressive AI model that's high margin. So anyway, I've got some exposure in PSP, just something I'm watching. I've got it down here. You know, I just bought a chunk of shares. It's a little like $1,500 investment, and I'm doing something at 70 and change, and then back down in the 60s as well. I can show you the chart right here. But I put that alert out a couple weeks ago. Yep. So I'm buying at 71.30, and I'll buy more in the 60s. I've got a pending order at $60, I believe. So I should have a pending order. Let me check. It shouldn't show up in history yet. PSP. So 71.35 looks like I didn't put it. Maybe it was a good. All right, I need to update that. I'm gonna buy more at like $60. So I'll put in a working order there. Okay, so I need to add that in. All right, good. I forgot about that. Okay, that being said, ratio spread is a strangle. No, it's not. Ratio spread is basically it's this. If I'm just gonna do a put ratio spread, I would sell 2 puts, and above that I buy 1. So it's basically it's like a naked put, or a naked put is if you don't want to own the stock. So I do a cash secured put, but what I do is I'll just use an example. I was talking about Google, right? So GOOGL. If I have a 155 long put and a 150, I sell 2 of them. What I'm expressing to the broker is I'm willing to own shares, and I'm obligated to own those shares at 150. Okay. But if I take this trade for a credit, let's say I got a $1.50 credit on the ratio spread, and also I have a $5 bear put spread, then what happens is I can turn my 150 ownership price into a 650 credit to lower my cost basis all the way down to 143.50. Now, if I just did a cash secured put, I'm only going to collect maybe $1 or $2. If I do a ratio spread, I can turn this into potentially $6.50. So even though I'm expressing I want to own the shares, I can own it for a little bit cheaper on that move. Right? So it's not a strangle. I just do it on the put side. I rarely do. I've seen some traders do that where I think it's called a Batman trade, which, you know, sounds cool, looks silly, but it's basically undefined risk, where you do a ratio spread on the call side, ratio spread on the put side, and you're actually trying to keep price in between. But that above on the call side is undefined risk, and you can take the shares short, which I obviously don't want to do. And on the downside, do I want to own the shares? Depends on the price of the stock. So anyway, right. And that's why I said I don't do ratio spreads with calls. All right. Anyway, I'm going to go. I'm going to do some more combing through the portfolio. I'm going to play around with the roll side on my my China exposure, and try to find some more trades. So I'll let you go for today. We'll be back in a little bit. All right. I'll see you tomorrow. Thanks. Bye.